Most people imagine Somali pirates as ragtag gangs firing rifles at passing cargo ships for quick cash. In reality, one single hijacking off the Gulf of Aden could trigger payouts exceeding $10 million. By 2011, piracy off Somalia's coast was costing the global economy nearly $7 billion every year. Insurance premiums for ships sailing through these waters multiplied more than tenfold within just a few years. Sailors and shipping executives began whispering a grim nickname for the region, the world's most dangerous corridor. How did a collapsed African state accidentally spawn one of the most lucrative insurance markets on Earth? This is the story of how Somali piracy quietly created a multi-billion-dollar kidnap and ransom industry. Before the ransoms and the risk models, this was simply a fishing community fighting for survival. Yet what followed would rewrite the rules of global maritime trade for more than 2 decades. Understanding this strange economy means starting long before a single pirate ever boarded a ship. Somalia's story begins not with pirates but with fishermen who lived along one of Africa's longest coastlines. Somalia sits along the Horn of Africa, bordering both the Gulf of Aden and the Indian Ocean. Its coastline stretches over 3,300 kilometers, among the longest in continental Africa. For decades, local clans fished sardines, lobster, and tuna in waters rich with marine life. In 1991, the government of President Siad Barre collapsed, plunging Somalia into total civil war. Before 1991, Somalia maintained a modest navy tasked with protecting these waters from foreign encroachment. Once that navy dissolved alongside the central government, the coastline became essentially lawless overnight. Without a functioning government, Somalia had no navy, no coast guard, and no way to patrol its waters. Foreign fishing trawlers from Europe and Asia soon moved in, exploiting the undefended coastline for profit. Estimates suggested illegal foreign fishing vessels extracted hundreds of millions of dollars in seafood annually without permission. Local fishermen watched their traditional fishing grounds stripped bare by unlicensed industrial fleets within a few years. Reports also emerged that foreign vessels were dumping toxic and even radioactive waste along the coast. Some of that waste reportedly washed ashore after the 2004 tsunami, sickening villagers along the shoreline. Clan elders in coastal towns held meetings debating how to respond to the growing foreign intrusion. Some communities initially welcomed foreign fishing crews, hoping for jobs or trade before resentment eventually took hold. Furious fishermen organized informal patrols, calling themselves Badadinta Bada, meaning saviors of the sea. What began as an attempt to guard fishing grounds slowly transformed into something far more lucrative. Armed men started boarding foreign trawlers, demanding fines they called taxes for illegal fishing. Those fines quickly evolved into ransom demands once the men realized how much shipowners were willing to pay. Within a decade, informal patrol boats had transformed from community defense into something else entirely. Coastal towns like Ale, Haradhir, and Garo became early staging grounds for these new maritime operations. Small skiffs armed with rocket-propelled grenades began chasing much larger commercial vessels far offshore. By the early 2000s, piracy had shifted from grievance-driven action into an organized criminal enterprise. Local financiers, many with no seafaring experience at all, began funding raids in exchange for a cut. Somalia's location made this possible, since nearly 20,000 ships pass through the Gulf of Aden yearly. That narrow waterway connects the Red Sea to the Indian Ocean, carrying much of the world's oil trade. Any vessel moving between Europe and Asia through the Suez Canal had almost no way to avoid it. Pirates quickly realized geography itself was their greatest weapon in this entire emerging enterprise. Behind every successful hijacking sat a surprisingly structured business model with clearly defined roles and shares. Financiers supplied fuel, weapons, and mother ships, expecting a fixed percentage of any eventual ransom. Attack teams, often teenagers, boarded vessels first, facing the greatest danger for the smallest share of profit. Skilled negotiators, sometimes fluent in English, handled ransom talks with shipping companies and their representatives. Guards were hired separately to watch over hostages during negotiations that could stretch for many months. Ransom negotiations sometimes dragged on for 6 months or longer as both sides tested each other's resolve. Shipping companies often hired specialized crisis response firms based in London, Washington, or Dubai to manage talks. These firms charged substantial fees on top of any eventual ransom, adding another profitable layer to the process. Every stage of a hijacking, from capture to release, had effectively become its own small profitable economy. On the other side of this equation sat an equally structured system based in London. Lloyd's of London, the centuries-old insurance market had long offered coverage for maritime war risks. In 2008, Lloyd's officially listed the Gulf of Aden as a designated war risk zone. That single classification meant shipowners suddenly needed special additional insurance just to sail through the region. A new specialty product called Kidnap and Ransom insurance began attaching itself to nearly every vessel's policy. These policies didn't just cover ransom payments, they also covered negotiators, legal fees, and crisis consultants. Specialist firms in London built entire practices solely around advising companies through hostage negotiations at sea. The first cycle of escalation began in 2005 when pirates seized the MV Semlo off the Somali coast. That vessel was carrying United Nations World Food Program rice meant for tsunami relief victims. Its capture proved pirates could strike even ships carrying humanitarian aid without fear of consequence. Shipowners paid the ransom, and within weeks similar attacks multiplied along the same shipping lanes. Word spread quickly through coastal Somali towns that hijacking ships could yield fortunes almost overnight. Ransom amounts during this early period remained modest, often under $1 million per vessel. Even so, that sum represented a fortune in a country where average annual income barely exceeded a few $100s. Young men who once dreamed of joining militias now dreamed of joining pirate crews instead. Coastal elders who once condemned piracy increasingly turned a blind eye as the ransom money flowed into local economies. Each successful ransom funded better boats, stronger weapons, and longer-range fuel supplies for future raids. Piracy had proven itself profitable, and profit, more than ideology, now drove the entire operation forward. The second major escalation came in November 2008 with the hijacking of the supertanker Sirius Star. This Saudi-owned vessel carried over 2 million barrels of crude oil worth roughly $100 million. Pirates seized it more than 450 nautical miles off the Kenyan coast, stunning naval observers. No one believed pirates in small skiffs could capture a ship nearly as long as an aircraft carrier. After 2 months of negotiation, owners paid a ransom reported near $3 million for its release. The attack proved distance and size offered no real protection against a determined pirate action group. Insurance analysts later called the Sirius Star hijacking a turning point that redefined the entire risk calculation. If a ship nearly 3 football fields long could be seized, insurers reasoned almost nothing was truly safe. Shipping insurers watched in alarm as premiums for tankers crossing the region climbed dramatically almost overnight. Every major shipping company now had to budget for the very real possibility of hijacking. Weeks later, pirates hijacked the MV Faina, a Ukrainian freighter loaded with battle tanks and heavy weapons. The cargo, bound for Kenya, included 33 Soviet-designed T-72 tanks and grenade launchers. Fears grew that these weapons might reach warlords, or extremist groups operating inside Somalia itself. American and Russian warships surrounded the vessel, creating a tense standoff that lasted over 4 months. The Faina standoff played out live across international news networks, drawing unprecedented global attention to Somali piracy. Eventually, the owners paid a ransom near $3.2 million for the ship's release. Analysts noted that pirates were now capable of threatening not just commerce, but regional military balances. The incident forced Western navies to acknowledge piracy now threatened regional security, not merely commercial shipping. International warships began patrolling the waters more actively, though pirates simply adapted their tactics again. Larger, more coordinated pirate action groups began operating farther from shore than ever before. The fourth escalation came through a tactical innovation known as the mothership system. Pirates began hijacking large fishing vessels or dhows and using them as floating bases far out at sea. Some motherships were hijacked fishing dhows crewed by hostages forced to help pirates navigate unfamiliar waters. These motherships allowed small attack skiffs to refuel and resupply hundreds of miles from Somali shores. Suddenly, pirates could strike vessels deep in the Indian Ocean, far beyond previous naval patrol zones. Attacks were reported as far away as the Seychelles and even waters near the Indian coastline. This tactic multiplied the reach of a handful of coastal towns into a threat spanning an entire ocean. The hunting ground for piracy expanded from a narrow strait into millions of square miles of ocean. Naval coalitions found themselves defending an area roughly the size of the continental United States. Every added mile of range meant more insurance zones, more premiums, and more potential payouts. The fifth escalation unfolded not on the water, but inside insurance offices in London and beyond. Lloyd's Joint War Committee repeatedly expanded its designated high-risk area as attacks spread further. By 2010, the war risk zone stretched from the Red Sea deep into the Indian Ocean. Kidnap and ransom insurance, once a niche product, became a standard line item for shipping companies. Specialist brokers in London reportedly built a multi-billion-dollar market almost entirely around Somali piracy. Brokers reportedly competed to offer increasingly specialized coverage packages tailored to individual shipping routes. Annual premiums for a single vessel transiting the region could run into the tens of thousands of dollars. Firms specializing in hostage negotiation and crisis response expanded rapidly to meet growing demand from shipowners. Even companies that had never faced an attack began purchasing coverage simply to operate in these waters. Fear itself had become a billable, insurable, and highly profitable commodity within the shipping industry. The sixth escalation introduced armed private guards stationed aboard commercial vessels sailing through dangerous waters. Private maritime security companies, many staffed by former Special Forces soldiers, offered protection contracts to shipowners. Guards typically carried firearms legally registered offshore, since Somalia itself had no functioning licensing authority. By 2012, thousands of armed guards were reportedly deployed across merchant vessels transiting the region. Not a single ship carrying armed guards was successfully hijacked throughout that entire period of deployment. Shipowners weighed the daily cost of security teams against the far larger potential cost of a successful hijacking. This new security industry created yet another profitable sector built entirely around the threat of piracy. Insurance companies began offering premium discounts to vessels that carried certified armed security teams aboard. Piracy had now generated fishermen turned raiders, London brokers, security contractors, and international naval coalitions alike. An entire ecosystem of profit had grown around a threat that began with a handful of skiffs. By 2011, piracy had reached alarming heights, yet the tide was already quietly beginning to turn. International naval coalitions, including Combined Task Force 151, intensified patrols across the entire region. The European Union's Operation Atalanta and NATO's Operation Ocean Shield coordinated warships from more than 20 nations. Armed guards aboard commercial vessels made successful boardings increasingly rare and dangerous for pirate attack teams. Financiers who once profited handsomely now watched expensive raids end in capture or complete failure. Pirate financiers began struggling to recruit new attack teams as word spread of rising failure rates. Somali courts, along with courts in Kenya and the Seychelles, began prosecuting captured pirates in growing numbers. Hundreds of suspected pirates faced trial and imprisonment far from the coastal towns that once sheltered them. Some captured pirates received sentences exceeding 20 years in foreign prisons far from their home villages. Family members back in Somalia often never learned the fate of relatives captured during failed raids. Some hostage situations turned violent, and negotiations occasionally ended in tragedy rather than a paid ransom. In one widely reported 2011 case, 4 American hostages aboard a hijacked yacht were killed by their captors. That incident hardened international resolve and triggered even more aggressive naval and legal countermeasures across the region. International media coverage of captured and prosecuted pirates further discouraged new recruits from joining these crews. Ransom payouts that once flowed freely began drying up as successful hijackings grew increasingly rare. Confidence among investors who once funded piracy operations collapsed alongside the diminishing odds of success. The golden era of easy Somali piracy, it seemed, was rapidly and irreversibly coming to an end. Facing collapsing returns, many pirate networks pivoted toward other criminal enterprises along the same coastline. Some former pirates turned to smuggling weapons, drugs, and migrants across the Gulf of Aden instead. Others reportedly drifted toward extremist groups such as Al-Shabaab, trading one illicit economy for another. Coastal economies that had grown dependent on ransom money faced sudden and painful contraction. Some towns that once thrived on pirate spending saw local businesses close as the money dried up. International aid organizations attempted to introduce alternative livelihoods, though success varied significantly across different regions. Fishing, ironically, remained difficult to return to since foreign trawlers had never fully stopped operating nearby. Meanwhile, the insurance and security industries built around piracy did not simply disappear once attacks declined. Kidnap and ransom insurance had already proven its value far beyond the waters off Somalia. Insurers began applying the same model to oil workers in Nigeria, aid workers in conflict zones, and journalists. Private security contractors, once hired only for Somali waters, expanded into protecting assets across multiple continents. What began as an emergency response to one regional crisis became a permanent feature of global commerce. The shipping industry had learned a lesson it would never fully unlearn: insurance follows risk permanently. The broader lesson for global business proves simple: once risk is identified, an industry emerges to price it. Somalia's pirates were fading, but the financial architecture they inspired had already outgrown them entirely. Statistically, the true peak of Somali piracy arrived during 2011, the single deadliest year on record. The International Maritime Bureau recorded 237 pirate attacks off Somalia's coast that year alone. Pirates were holding over 700 hostages and dozens of vessels captive at various points that year. Global ransom payments in 2011 reportedly totaled around $160 million, an unprecedented sum. Broader economic costs of piracy that year, including security and insurance spending, reached nearly $7 billion. Some analysts placed the true economic cost even higher once ripple effects on regional trade were included. War risk insurance premiums for the region had by then multiplied more than tenfold since 2007. The kidnap and ransom insurance market tied to Somali waters was estimated in the hundreds of millions annually. Insurance brokers in London reportedly described 2011 as their single busiest year handling Somalia-related claims. Naval deployments alone from various nations cost taxpayers many hundreds of millions of dollars that year. Never before had a handful of coastal fishing towns generated such staggering global financial consequences. The decline that followed resulted from several forces converging at almost exactly the same moment. Naval patrols from dozens of nations created a nearly continuous protective corridor through the most dangerous waters. The widespread adoption of armed guards made hijacking attempts far riskier and far less likely to succeed. Shipping companies adopted formal guidelines known as best management practices, including razor wire and citadel safe rooms. These citadels allowed crews to lock themselves away safely while awaiting rescue during an attempted boarding. Legal crackdowns onshore disrupted financing networks, arresting key organizers who once bankrolled entire pirate operations. Regional governments, supported by international funding, began building Coast Guard capacity within Somalia itself. Regional cooperation among Somalia, Kenya, and neighboring states improved information sharing about suspected pirate activity. Satellite tracking and improved intelligence sharing allowed navies to intercept suspicious skiffs before attacks could begin. Shipping companies that once viewed security spending as optional now treated it as a basic operating cost. By 2012, successful hijackings had dropped dramatically compared to the staggering numbers recorded just 1 year earlier. By 2013, the International Maritime Bureau reported only a handful of successful attacks off the Somali coast. The combined weight of these measures achieved what individual efforts alone had failed to accomplish for years. What once seemed like an unstoppable criminal wave had been contained through coordinated international pressure. Today, the raw number of Somali pirate attacks has fallen to a small fraction of its former peak. Yet, the financial machinery those pirates accidentally built continues operating quietly across the global shipping industry. Lloyd's of London still maintains designated high-risk zones inspired directly by the Somali piracy crisis. Kidnap and ransom insurance, barely a footnote before 2008, is now a standard multi-billion-dollar industry. Executives traveling through unstable regions, aid workers in conflict areas, and even wealthy tourists now carry similar coverage. Private maritime security firms that once guarded oil tankers now protect vessels facing piracy risks worldwide. Modern hotspots off West Africa and Southeast Asia rely on protocols first developed during the Somali crisis. The negotiation firms, crisis consultants, and legal specialists born from Somali hostage crises still operate today. Universities and business schools now study the Somali piracy era as a case study in market creation. Risk consultants often cite it as proof that instability anywhere can generate profit somewhere else entirely. Former naval officers who once patrolled these waters now work as consultants for private security firms. In many ways, the global shipping industry's entire approach to maritime risk was permanently reshaped by this episode. What began with hungry fishermen guarding depleted waters ended up rewriting insurance contracts across entire continents. The pirates themselves gained little lasting wealth. Most spent their ransom money quickly and were later imprisoned. It was the insurers, brokers, and security contractors far from Somalia who built the most enduring fortunes. The Gulf of Aden itself remains busier than ever, carrying an even greater share of global trade today. Ships still pay premiums calculated using models refined during the height of the Somali piracy crisis. So the next time a cargo ship silently crosses a distant ocean, remember the invisible premium riding alongside it. That premium exists because a handful of desperate men once turned stolen fish into stolen ships. A crisis that began with empty fishing nets ultimately filled boardrooms and balance sheets thousands of miles away. And in turning fear into a financial product, they built an industry that quietly outlived them all.